Welcome to the Tree Care Business Show. I'm your host, Monica Hemingway with Tree Care Marketing Solutions, and today we're doing a deep dive into the high-stakes world of mergers and acquisitions in the tree care industry. Joining me today is David Mitchell from Haas Tree Advisors, one of the managing partners there. He's going to share all his secrets with us. No,
all of them. Yes.
I'm not going to ask you to do that, don't
That's
worry.
okay.
But can you start by telling us a little bit about what is Haas Tree Advisors? What do you do?
Yeah, absolutely. So first, thank you for having me on. But Haas Tree Advisors is the only M&A advisory firm in the tree care space. And what that means is a lot of you have probably gotten calls from private equity or investors who are looking to purchase your business. Our job is to work with business owners to determine the best fit, advise on valuation, do all the financial due diligence with you to take you to market, and so that you can get the best offer. We field offers typically from multiple companies anytime we take somebody into the market, and that is with the express intent on taking on a strategic investor who is going to want to purchase the company. Sometimes to have you continue, or sometimes for you to be able to exit. So our job is really to be your hired gun to support you as you go through, like Monica said, a pretty serious process, but we try to make it as painless as possible.
Okay, so you mentioned you're a M&A advisory firm.
Yeah.
Now we know with deals, there are brokers involved.
Yeah.
There are sometimes investment bankers involved. Where does an M&A advisory firm fit in that?
Yeah, that's a great question. So if you've heard of Goldman Sachs, investment bankers, they're usually taking on very large deals, sometimes in the hundreds of millions. Usually they might be taking companies public. A business broker on the other end of the spectrum is going to be very small. Usually it's local. They might be selling one tree care company every 10 years. They are probably going to be dealing with restaurants and the local gym and maybe another service trade. But we in the M&A space, our M&A advisory space, are focused specifically on the niche of tree care. To our knowledge, we're the only ones who are doing that, but we take on larger companies than probably a typical business broker can. We only really take companies to strategic investors, so larger companies, private equity, and we're not going to be specialized on finding the investor in town, but large strategic players that are nationally based. What that also means is we have relationships with many of the large investors, so we know their profile. We know what they're looking for, what are the metrics, what are the lines of business, where are they looking, to help us make sure that if we're going to take you on, we're going to be able to close a deal if that's what you want. Obviously, throughout the process, our job is to advise. Your job is to make the final decision on, is this the right deal for me?
Okay, so between the two,
Yep, we sit in the middle.
What size company? You said larger companies. What does that translate to in, say, annual revenue?
Yeah, in this space, what we're looking at is on the low end, probably about 1.2 million is a good threshold. That would be probably the smallest we would be able to find the correct buyer for. On the high end, we could be talking 25, 30 million in revenue, could be higher, but our sweet spot is probably in that middle market before investment bank is really interested. But yet again, kind of beyond what the local business broker would know. The big difference is your local business broker, great guy, great gal, they might be wonderful people that you go to church with, Rotary with, but they're Googling the largest companies in this space. We have their cell phone numbers. We have direct access. So even if it's not a fit for them, we're going to get a yes or no instead of landing in their spam inbox.
Spam. That's the last place you want to end up if you're trying to sell.
No, yes.
So how do you? I'm sure this is not something that's going to be offered free.
It's not. Yeah. You're not free.
I'm sure people want to know, how do you charge for your services?
Yeah, it's a great question. So we do something that's industry standard, which is it's a percentage-based success fee. For us, 95% of what we charge is on a success, so on the sale. So, and that would be on the overall valuation. We do typically take a small retainer, about 5% of what we expect the success fee up front. The reason why we do that is so we get people who are serious, who are going to really take offers seriously. So we're not wasting your time and our time and the investor time. But that percentage varies. The smaller the company, the larger the percentage. The larger the company, the smaller the percentage. The fee obviously goes up with the larger the company, but it's not proportional. It's not, $1 million business versus a $10 million business. The fee's not 10 times larger, if that helps. So each deal, we give a specific number, and that's very clear once we start an engagement letter.
So basically, it's a percent of what it sells.
Correct.
Essentially.
Yep. The overall valuation at the end. So kind of like if you go to sell your house, the real estate agent is going to take a percentage of that. We're going to do this thing. So it's, a lot more people are selling their houses than their businesses. So I try and bring in examples that maybe are more relevant.
Okay, so somebody's thinking about selling their business.
Yeah.
Walk us through what it would look like if they were to come to you. What step by step, what would the process look like from first contact to close deal?
Yeah. So the first thing my team and I do is we have a discovery call just to get to know you, get to know your business. We're going to ask some financial data at a high level to just kind of see, hey, we're going to know your location, but we're going to want to know, generally how much are you doing in revenue? Generally, what is the type of service mix that you're doing? What is your retention? Are you growing? Are you shrinking? Things like that. Then from there, assuming that both sides feel good, we'll go to evaluation. That valuation is there to help both sides, us and any owner, understand what we think we could get in the market today. Half the time we do those valuations, we look at the financials in depth. We do sign an NDA. That's really for the owner's purposes. You don't want anyone in my position going around and talking about your financials without your permission. But we look at those financials, give that valuation in order to help you understand, hey, where are we? In some cases, we say, you're not ready today. Had this conversation recently with somebody in the Northeast. Next year, if you hit this threshold in your market, this is where the investors are, and this will help you also pay off a year of debt, which will help you put more in your pocket, because ultimately he has retirement goals that he needs to hit. But assuming the valuation is where you want it to be, you feel like we're a good fit, then we provide the engagement letter. That's really where real work starts and where we really earn our fee, I guess is the best way of putting it. So we put together, we do a deep dive into your financials, into all of your records, anything that an investor would want to look at. We package that together, put together what they call a SIM. That's a confidential document that we would send to an investor. We put that together. It's our marketing materials that we would send over to any interested party that we know would possibly be a fit. Once we're putting that together, we're really digging into the business, putting that together, and really trying to make your business look as good as we can on paper. Obviously, every small business has, they have a down year or something happened, maybe an accident, things like that. We're trying to go in and make your business look as clean and as polished as possible. We're never going to be able to hide anything, but we don't have to show off the warts. So what we do is we clean everything up, make sure that it's really clear for anyone who we're going to send this to, and then we go to those strategic investors to gather interest. They're going to take a look at that. First, they're going to look at a high-level document, then they'll look through in more depth, and then our process from there is if they're interested, we start having conversations, the owner and the possible investor. That is a process that is likened to dating. You want to find somebody that is a good fit. And at the level that we're talking about, it usually is fit-based and valuation-based. Obviously, if we're talking millions of dollars of gap in one offer versus the other, it's pretty clear where to go. But if you're talking a $50,000, $100,000 difference, you really want to choose the person that you and the group that you feel best with. So in that process, that's where we really want to address fit, play matchmaker, and then they're going to put together their offer. And that offer we're going to receive. We're going to make sure that we can explain everything to the owner in plain language to say, hey, this is why this is a good deal, or this is why this is different. You can structure a lot of these transactions a lot of different ways. So we're trying to not just look at what is the top number, but what are you walking with today? Is there stock that's going to roll forward? There's a lot of different things we can talk about in a minute, but making sure it's clear why you're going forward. Then once you decide, hey, this is who I'm going with, that's when it gets very serious. The other side now is going to invest hundreds of thousands, could be $100,000 to $200,000, $300,000 in due diligence. It can be a grueling process, especially if you're going to do it alone, where you're laughing because
Yeah, been there, done that.
Yep.
I've heard it compared to a colonoscopy.
Yes, yeah. So our job is you got to keep running the business. Can't drop that ball. So our job is to take it to close. And that's why you want somebody who has experience in this space that has a track record. So our job in that due diligence is really to make sure it goes smoothly. And if you get upset, shooting off an angry email to us is fine, not to the investor. So we are kind of the buffer. We play in that middle space, and then we take it to close. That usually will happen it could be anywhere as low as 30 days to 120 days. But we're trying to get that done as quickly as possible. And then deal signed, and now you're on with your life. And hopefully you go on to refer us to many other people.
Okay, so many questions.
Yes, please.
With all of this.
Long answer.
So yes, but thorough, right? So I think one of the things that brings up is that this is not a simple process. And trying to do it yourself with all those things you mentioned that you have to go through may not be the best idea. It's like having that professional help, even though it's going to cost you some amount, is probably well worth it.
Yeah.
Especially if it prevents you from getting distracted from your business and kind of ruining the one thing that you've got going for you, which is your business that you're trying to sell.
Monica, I could get up in a tree today and chop off a limb, but I would be terrible at that. I would probably have a mistake and hurt somebody or hurt myself.
Fall out of the tree.
And you're experts in this. You do that every single day. What you want on the other side, you're gonna probably sell your business once. If you're really successful, you do it a few times. Our job is to do that every single day and make sure that we're helping you avoid the mistakes. Probably, I'm sure most of the people I talk to say, I'm competing in a couple different places, but I hear this a lot. 2 guys in a truck, they're cheaper than me. Well, your expertise is why you get to be paid a premium. Same for us. And yeah, it's not cheap, but it's quality. And that's whoever, if it's not us, and I always say this to people, if it's not us, having someone there to guide you through, walk you through is really important. You got to trust the people because it's not going to be 30 days. Anybody who tells you that is a liar. It could be 6 months, could be a year. We're trying to get everything done between 6 to 9 months, but I would never tell somebody, hey, you're going to sign on the dotted line and we'll have money in your account a month later. It's just not going to happen.
And yes, be worried if that's what you're
Yeah.
hearing from somebody.
Yeah.
So, okay, you raised several issues. One is people are wanting to sell, and you mentioned depending on why you're selling.
Yeah.
What are some of the reasons, most common reasons that people look to sell their business, and how does that change what kind of a buyer you're looking for them?
Absolutely. So most obvious is we're at the end of our career. We don't have somebody else to take over it. We've explored selling it to maybe our employees or our children or whatever, and that's not going to happen. So that's bucket one. Bucket two, I think, is something that a lot of people don't think about. These are people who do have time left, multiple years. It could be anywhere from 3 to 20. And especially with the ones who are earlier, what I tell them is you have bet it all on your company time and time again. Generational wealth is typically built with other people's capital. So you're able to continue on. Most of the strategic investors, actually everyone we've talked to, wants somebody to stay on or have a clear number two. So if we are talking to somebody who's going to stay on, fit matters almost as much as evaluation. And then what is post deal? What are all the promises? Now in bucket one, we're looking for somebody who, frankly, if you don't have somebody who can take over operationally and do the sales, it is going to be harder to sell you. Even if you're hitting revenue thresholds that we talked about earlier, because the CEO of that large company does not want to come and run your business. I'm sorry. They are hoping that they can have somebody, and they're not asking you to stay forever, but making sure that you have somebody. So that succession planning is important. But either way, fit is important if you're staying or leaving, because so many of the people we talk to in this industry care about their employees. And they are going to continue on your legacy, and this is your legacy. So either way, but there are some investors who are outright, no, we will not take a company where the founder won't stay. So we just put them in the no bucket. You have a lot more options the earlier you start this process.
Okay, so not only are there different types of sellers selling for different reasons, it sounds like there are different types of buyers as well that are looking for different types of companies, but also have different goals in mind for what they're trying to accomplish by this acquisition. So can you walk us through the types of
so buyers? In this space, we're seeing private equity is obviously, there's a lot of buzz about that. Even at this conference, I see a lot of the guys walking around. They're great. Thankfully they are here. If not, there wouldn't be as many options. So this is a good thing. We think a lot of them are above board. They're great guys. They're very smart. They're very smart. So that's part of why it's helpful to have somebody who's played the Wall Street game on your side. But then there are the very large companies. I'm sure you could name them. They are probably in your local market, and they might be employee owned, and they might be companies that you are more of the name brand. So those are the two we typically are dealing with, and in some cases we'll deal with family offices. So somebody with large institutional wealth who has bought at least one tree care company that is looking to do more. So in that case, yet again, we don't want to take somebody through a process where they've never bought a tree care company. They don't have any industry experience. We just see that's a problem. And then, within that, there are people who are looking for residential only, commercial and residential, commercial only, tree line, utility work, vegetation management. And they're pretty clear. If you're vegetation management, some of them, they won't touch somebody who's residential. So, if I took that's part of the problem. If I just Googled who are the biggest tree care companies, I'm going to find a vegetation management company in that list. And if I don't know any different, I'm going to try and take somebody who's residential to them, and they're just not going to take that
They're
seriously.
just going to laugh. Right?
They're going to laugh, and and they'll be kind, hopefully, or they'll just ignore your email. But and that's why we always ask about service mix and what percentage and customer concentration. If you have one large client that makes up over 50% of your revenue, that is going to be a real sticking point, and we're going to have to really work around how to make that happen.
High risk.
Yeah, the investors don't want that.
No.
They want, they're trying to make returns on whatever they pay for your company, and if that one client walks away, well, half the business is gone. So,
How about location? Well, one of the things some of the PE firms that we've been working with have made it really clear they're focusing on Mid-Atlantic, Northeast, whatever. They're trying to grow their footprint.
Yeah. Where sports teams are very desirable for anybody who's in residential commercial. So larger markets. If you're in vegetation management, you can be rural. You can be in the middle of nowhere because you're working on utility lines. Now, but I'm going to focus this more on the commercial side. The bigger the area where you're located, the better. The better for your valuation. I know you can't control that now where you started your business, but just know that you're going to have more options if you're in a large city. Now, on top of that, yes, there's some companies that have told us outright, we won't buy in this state or we won't buy in that state. You probably guessed which ones those are. And then some are saying, we want to be the king of the Midwest or the Southeast, and we're going there and there and there. So that was part of our due diligence, and what we built towards is to understand. And so when we talk to you, we know, and like I said, we've come across companies that are in our revenue thresholds, really good companies, but something in that I just described doesn't fit, and we just know there's not a buyer. So we have to say no, or you got to get to a different revenue threshold to be able for us to present you. So that matters. The smaller the company, actually, your competition being private equity is good if they're in your town because they might take you. Whereas if there's no one in your city operating and you're smaller, they're looking for the big company that they can build large systems out of. Hopefully that helps.
So you've mentioned private equity as being one of the key players here. I know there are a lot of different PE platforms, firms, whatever. They all have different names for it, but they seem to have different goals. What are some of the outcomes that they're looking for, and how do those differ?
Yeah. Well, first off, I think private equity is just anybody who has private capital, investors. So this can be, it could be a very wide range. The really large funds versus the very small funds are very different too. So in most cases, they want to buy companies over a 4 to 6 year range to then go sell again. If it's within their own fund or to another private equity company or a larger strategic.
So they're trying to combine them so they've got a higher revenue.
Correct.
Amongst all of it, make it more attractive to another buyer.
Yeah. So there's two reasons why they do that. One is they think, hey, strategically, we can put in some of our systems, we can help you. Maybe we're really good at technology, or hey, we've got a great marketing, or whatever it may be. And so they think they can bring in more efficiency. Two, the larger the company, the larger the multiple. So the term is multiple arbitrage. So multiple arbitrage just means if you combine, let's say, 10 companies that are worth $5 million each one of those is going to get a smaller multiple 3 times, 4 times, 5 times, 10 times, whatever it may be. 10 times probably not at that low. No. But they're going to get a smaller multiple, and then even if they don't grow that, now 10 companies that are $5 million each, $50 million, they're able to leverage that and get another one or two on that with turns. The term is turns on the, but that just means if you sold for a 5, they're looking for a 7. So 5 times or 7 times. As you can imagine, 7 times EBITDA versus 5 times EBITDA can be a lot. So if they just do that without growing the business, without making it more efficient, they still make money. So that is the private equity math.
So that's why private equity is
Loves
part of the reason why they're in tree service, as
Yes.
well as the fact that you can't outsource it to AI.
Can't, yeah,
Tree work, it's always going to be people, so
absolutely. Yeah, yeah.
there's always going to be a need for it.
There's, yeah, there's technology coming in. I've seen some of the mechanical machines that are coming in, but yeah, this is the people. I talked to a very large buyer, very large company, and he laughed. He said, a lot of the guys I talked to are afraid we're going to fire all the guys after they come in. He's like, he'd done a lot of transactions. He's like, we've probably gotten rid of 2 or 3 people across all these transactions. But this is a people business. What am I going to do? Get rid of them? Like, I need them. That's what I'm buying. So he laughed because he's very much focused on, we're buying the people and the systems and the processes too. But these companies don't operate in a silo where, technology companies, you can't get rid of a lot of people, frankly.
Yeah. One day won't need any of them.
Oh, yeah.
But okay, so you've mentioned something that comes up a lot in discussions. You mentioned multiples.
Yes.
And EBITDA.
Yeah.
For those who might not be familiar with what that means, tell us what EBITDA is, and how what a multiple is, and how those two things go together.
So let's start with EBITDA. It's kind of the even playing field of investing. So it's earnings before interest, tax, depreciation, and appreciation. It's an accounting term, but it's basically saying, if I were going to boil it down, how much profit after we take out the owner salary, like what the owner takes home, and we're going to adjust. And our job too is to adjust to make sure those numbers are market standard. So, I came across a young owner who's paying himself $30,000 in a large market. We have to go back to him and say, hey, to replace you, it would cost much more than that. So we got to factor that into your profit. Whereas somebody who's using, let's say they're running some personal expenses through, or they're going to, we're going to adjust the other way. Now, I would also caution you, please do not run personal expenses through your business in excess. Sure, if there's some things I totally understand, but a $30,000 purse for your wife, please don't. Plus, you might have the tax man call. But you asked about the multiple. Now, so EBITDA, if you look at EBITDA, it's kind of the industry standard of profit, best way to say profit. And multiple is just how many times that number. So let's say, I'm going to use very easy numbers, $1 million. If I said your multiple is 3, your EBITDA is $1 million, 3 times $1 million, $3 million. If I can get you 3.5 times, now it's 3.5 million. If I can get you 5 times, that's 5 million. So that's why every turn, every half turn is so valuable for the owner, and why we're fighting for that. And actually, typically, what we've heard from the investors, and we don't get to see every other deal, but they're willing to pay a little extra because we do a lot of the cleanup work. We are doing some of the cleanup, and we're going to get the deal along faster. And plus, they're in a blind bidding competition. So as you can imagine, if you don't know what the other side's bidding, you're going to put your best offer forward.
Yeah. When you're talking valuation, then what you're really talking about is the multiple on your EBITDA.
Correct.
That's the valuation.
Yep. And I'm going to throw out something that there's some guys and gals who get this, some who don't. You buy your equipment. It's great equipment. Everybody's got the best equipment. I'm sure you do too. They think that they're going to be able to take that valuation and get the price of the equipment back. I am. I have this conversation about once a month where I have to explain the equipment is part of the business expense. Without the equipment, the business wouldn't be able to do what it does. So that is baked into your valuation number. So I like to clarify that. Anybody who tells you otherwise in this industry doesn't know. And the problem is they think, oh, well, I should be able to sell that and do it differently. If you sell the equipment, you're going to sell it at pennies on the dollar. The business at your level is worth more than equipment, but you don't get to add it to at the end. Unfortunately,
it's part of it.
It's part of it.
Just like your people and your processes and your customer list and all the rest.
You wouldn't expect to sell off, be able to contract out your employees afterwards. So we're not going to be able to sell off the equipment beforehand. If you start selling your equipment right before the sale, we're going to have a conversation. And, it's kind of like opening your credit card right before you close your house. Don't do that either.
Okay, so if the valuation is a multiple of your EBITDA, what can you do? You're thinking maybe I'll sell in 2 years or right. What can you start doing now to get your business to the point that you're going to get the highest number?
Yeah, I'll plug our service first. Come get an evaluation. And we do this valuation at no cost. And like I said, we will tell you where you're at now. If you don't know how to calculate that yourself, which is totally fair, or you don't want to, or you just want somebody else's opinion that actually sees transactions happening in this space, we don't put a calculator on our website because we will look at your numbers for real. And we don't want to tell you something that's fake. So I would start with evaluation. But things that matter. One is, all right, if you're not staying, who's the number two? And no matter what, who's your number two? If you can get a second layer of management in, does operations, does some sales, that is incredibly valuable. Two, make sure you are running everything, and this is absolutely clear, everything through the business goes to the tax man. I know that, I've heard this multiple times. Well, nobody does that. Well, the people who sell typically do.
Doing
lots of cash.
Yeah, exactly.
Tough. Yeah. It just brings up questions you don't want to answer, and it can be a deal killer. So those are just starters. But all right. What if you're going to buy equipment? What's the return on investment on that? That's why the valuation is so important. If you're going to hire that number two, what would that add to your business? And then other things I would be thinking about is how do I keep costs low as possible. You don't want to cut, but if you can keep your costs low, but keep growing the revenue. The more you grow the revenue, honestly, what you do in the marketing space is very valuable. I'd love to plug your service too, but and that's why we think, the more revenue, every single investor feels more comfortable the more the revenue is. So I'd be looking for more revenue to a point. There's a point where you can grow, and it doesn't make sense because you added a ton of equipment and whatnot. So that's why the valuation is so valuable.
So you're trying to grow your top line, but also your bottom line.
Yeah,
both gotta be.
Yeah, you got to make sure that it makes sense. If you have to add a couple $1 million of equipment to add $500,000 of revenue, we need to talk. We need to make sure that that's going to make sense. And what's your time horizon? So that I kind of hit on a few of those big points. And I would say if you're making big strategic decisions, hey, I might move into a new market. Hey, there's a guy in my neighborhood or my town that he's going to retire and he doesn't have any other options. I might pull him in. Yet again, let's have a conversation. If you're going to make big decisions and you're 5 years out, whatever, let us know so that we can tell you, is it worth it? Or what's the probability it's worth it? So hopefully that.
So how about things as well, like working on your SOPs or your
Absolutely.
Safety?
Yes.
Or those.
I forgot to plug a few things. TCI accreditation is a great thing.
Yeah.
It actually looks very good. It's not going to net you a hugely different multiple, but it is a check mark that we hear consistently. Good. SOPs, absolutely. If you're not on a CRM, if you're not on a single ops, a Java, a Arbor, Gold, any of those, and I'm not going to tell you go one or the other. You got to figure out what's the best for your business, but having that together, all that data makes it so much easier, and it also tells the investor, I'm organized. I get it. I understand. I'll try and grow it. And then, yes, the safety. Look, if you have a big safety problem consistently, red flag, automatic red flag. And, no one wants to buy a problem, right? You don't want to buy a problem. So make sure that you're staying up, and safety is key. And, and honestly, it'll keep your oon margins better.
Your insurance.
Yeah. And plus, as I talk to everybody, at least in this room, they're concerned about their employees. So it's a good. Anytime we can say, hey, keep your guys safe, that is a good thing. So.
How about diversifying your services? Does having a full range of services, including PHC, for example, does that make a difference? Or
yeah, I would say the PHC is looked upon as a very good thing. Now, if your time horizon is a year, don't invest that just to tack it on. Go do what you do really well and double down. Now, if your time horizon is a little bit longer and you have a way to make that happen, yes, I think that's great. If you're not doing any commercial and you think you could go sell it in the commercial, that could be a good thing. But it's better that you're really, really good at what you do than too diversified too. So it is a depends answer, and your time horizon matters a lot in that. But I would also say, like, if it's going to distract you from what you do really well, I really caution you against it. But PhDs are great. Look, everybody loves a good PhD program. It's great revenue. It's a good, There's a good thing. And if you've already thought about that and you think, hey, I can implement this and do this well, but you're not going to turn on the faucet and tomorrow it's $1 million business by itself.
No, it takes a while.
Takes a while, yes.
Yeah. So from a marketing standpoint, it's also a lot harder. So.
Yes, yeah. It's just different. And if you're the stump guy in town, that's a big shift in your business. So
it is.
I imagine you don't deal with a lot of just stump guys, but yeah.
We don't deal with any.
Yeah.
Actually.
Yes, I kind of figured.
Yeah, we're more full service tree companies. Okay, so that is what you can do now. Now, as you're looking to sell and you've got these potential buyers out there, as the business owner, what are some things that you need to be thinking about in deciding which of these potential investors or buyers are going to be the right one for you, and what are the red flags to look for that stay away, don't go there?
One, this is down on the TCI thing. Talk to the people who've sold already. Don't just listen to us. We're going to try and direct that too. I think that it's really important to know when you're being sold to, right? My job is to do business development. I'm obviously, I'm going to try and give you the best advice possible, and I try and be as transparent, but so is the private equity. They are going to sell you until you get it to the door. So talk to the people who've actually been in it. Now, I wouldn't talk to just one, because one personal experience could be terrible or amazing. Get a small sampling. Now, if you're with us and you're at that point, don't go solicit those people by yourself. We'll help you with that. We'll work with the sellers. But if you're in these TCI rooms, grab the people who've gone to exit and talk to them about it. How's it been? What's it like? What was the downside? What was the upside? Because what might have been really bad or good for them may not be the same for you. That might not be a problem for you. Or it might be, hey, that sounded great to that person, but horrible to you. So I'd be talking to them. I would want to know, where, if you're going to one of the large firms like Davy, they're going to continue to go. But if you're going to a private equity, where are they in their fund cycle? So if they just raised a bunch of money to buy more, it's probably a really good time to think about that. Now, if they're at the end of their cycle and they're trying to pick up companies just at the very end, you might get sold to the next guy, and you don't have any control over who that next boss is, who that next investor is. So that's part of what we do. But if you can get that due diligence, if you can hear that from your friends, you're welcome to that. We'll help advise that once you get into our ecosystem, I guess. But kind of know where the land is. Like, what is the lay of the land? And I'd be looking out who's buying in my area, because if they bought somebody who looks just like you, they're probably not going to buy you.
That's a good point, right?
Yeah.
Yeah. Okay, so the different PE platforms have different models.
Yeah.
For how they're going to bring in a new company.
Absolutely.
Talk to us a little bit about that. What are those different models, and why would somebody decide that one model is better for them versus another?
Yeah, talked to one owner who is like, hey, they saw all the data I'm tracking, all the things I'm doing, and like we're talking across the network, and they're asking me how to do things, and I'm getting a little bit here and there from them. He loved it. He's a large company out of the Southeast, very happy. So I'd be asking them, like, how much do the other branches or other former owners, how do they collaborate? If you're going to be stuck in a silo, why? But I talked to one that's very small. They're pushing in with their guys, and they told me, hey, our entire job is to make them better. So we, bring them together. We do group trips, and we do all the things. So some people, that sounds awesome. Some are like, I don't want a group trip with a bunch of people I don't know that well. So all of them are going to try and integrate you into their general system. So they're going to want some consistency. Now that doesn't mean you're going to have to switch from one CRM to another necessarily. But if you're not on a CRM, you're getting on one. Plan on that. So I'd be yet again asked. Those are questions I'd be asking in the due before we get into the offer, accepting the offer stages. What does your integration look like? Who does the integration? Can I meet that person? Can I talk to them? Because like I said, there's somebody who's really small that I'm thinking of. Well, there's only a couple people, so you know who they are. But in the very large organizations, the guy who does the M&A deal hands it off usually to an integrator, and that person, you're going to want to know who that person is at some level.
How they're going to approach it.
Yeah. And what they're going to ask you and what they're going to ask you to do.
Yeah. So the way that we tend to lose our clients is they get acquired.
Yeah,
that's pretty much it.
That's a good reason.
They're gone.
Good reason to lose them. Hard for you, but good for them. Yeah.
We're really good at growing them and losing them that way. But we've seen different outcomes. In some cases, they continue running their own business. Nothing much changes except for the fact that they've got now more capital to work with.
Yeah.
They're getting a salary. They've got to keep their P&L looking good, but they're not necessarily, and grow their company, but they're not responsible for it in the same way.
Yeah.
Others, it becomes, well, I don't care how you did it before. You're going to do it our way now.
Totally.
And this is it. And you're just another employee.
Yep.
Number in our company. And that works for some of them. Others, it's, I'm out of here. Thank you for the check. I'm gone.
Yeah.
Bye-bye. Right?
Yeah.
So there's very, very different ways to exit.
Yeah, absolutely.
Are you going to get a different valuation depending on what you want to have as the outcome?
Yeah, yet again, if you're staying and you're willing to stay longer, they're going to ask for a multi-year commitment if you're going to stay. That's not written in blood, but they're going to incentivize you through financial means to do that. Your valuation probably will change. It probably will be better. That's why I would say, like, if you're thinking about it, this is a good time to think what could life be afterwards. But the people who do stay, yet again, back to, I said this originally, the generational wealth is a lot of times built, by being a minority shareholder. You know, you go look at the richest guys in the world. They are not, Jeff Bezos is not a majority shareholder of Amazon. Elon Musk is not a majority shareholder of his business. They're minority shareholders, but they're not risking their net worth every single day on their own labor. So what it allows you, if you're going to continue to work, is and most of the firms are going to have some stock program, something where if you continue on, you get to see the value you build. You don't get 100% of the pie anymore, but sometimes the 20, 30% of the pie 5 years down the road could be worth as much as the first check that you got, which, the law of growing, or the exponential growth there, if you can double your money that quickly, or not double, yet again, taking 20% of what you owned and to be as much as your 100%, you can't get that in the public markets. It's incredible, but that's not a guarantee. And you got to know, I got to be good with the first check, and hope, our job is to help you evaluate, would the second check come? Because I'm sure a lot of your clients have heard this, the second bite of the apple is promised in almost every deal. How likely is it that you get that second bite? And that's part of our job. To evaluate, will that happen or not?
In your experience, how likely is it to happen?
I think your best bets are established operators in a lot of cases, but there are some small ones that they're showing that they're proving growth year over year. That very likely. But I don't want to put a percentage on it, but it is possible. And you can't calculate your retirement fund or your walkaway money thinking this is a guarantee. You got to know, like any other investment, it may not happen. And even the best, Warren Buffett doesn't make money every year. So if he can't do it, then what promise does anybody have? But in this industry, it's hot and it's good. And it's not just this; it's HVAC, it's plumbing, it's happening in a lot of these home service industries. This is a very hot industry right now. Hopefully, it'll continue to be that way. And then, as long as there's somebody on the other end of that transaction, you're going to get that second bite now.
Okay. So what you're talking about is you get some money up front when you sell.
Yep.
But you don't get everything, or you reinvest part
Yep.
of that into your.
I'll just use really simple numbers again. This is not the value. You get $1 million valuation. They'll give you $1 million check. You got to go pay your debts, do all that, pay the tax man. But let's say they say, hey, you're able to take up to 30% of that and invest it into our stock. In some transactions, that's stock. They're never planning. They're going to hold that forever. So you're going to get dividends. But I'm talking about more of the private equity space. Once they go to sell that $200,000 you originally invested, then like any stock transaction, you would get a portion of the bigger share. But that does come out of the bigger check. So you just have to decide, how much am I willing to leave? For our younger owners, that math is really nice. Whereas if you're only going to stay in for a year, we should really consider, is this worth it or not?
Yeah, take what you can up front.
Yeah,
as opposed to hoping.
Yeah, exactly. And you're not, and if you're leaving in a year, they're not going to give you this as favorable of a terms as somebody who's planning on staying for 5 years or longer.
Right. So there's a lot to think about when you're thinking about exiting.
Fairly complex.
Yes,
it's fairly well, and it's doable. It's it's been done. yet again, we think that, and what we see in our results are that when we take you to market, we feel very confident that we're going to get interest. We don't take on people, and I tell more people no than yes, because even though we had an initial conversation, there's only a very small percentage of the companies that are even transactable in this industry. Now, if you're showing up to the TCIA expos, the winter managements, they're able to employ you, the percentages are a lot better.
Yeah.
You're in a different echelon, but I have to have a hard conversation at least every other week with somebody saying, "Hey, you're just not our fit. There is a business broker in town, and here's who I point you to, but your best hope is somebody will buy you locally and not one of the big investors."
Or just want to buy the various assets in your.
Yeah, you hope that it's not an asset sale. If it's an asset sale, you're going to get pennies on the dollar. It's just, you're not going to, very few guys walk away thrilled with that outcome. It's,
Because you're not selling a business.
no, you're selling assets and they're depreciated, and so, and you probably bought them with cash or financed it, and it's not going to be worth what it was worth when you bought it.
No.
It's not.
So, okay, so to close then, somebody who's thinking about exiting as soon as possible.
Yeah.
That happens, right? Health reasons, family reasons.
Yeah.
They're done.
Yeah.
Versus somebody who is thinking a few years down the road, I might want to. What's the one piece of advice that you would give to each of those two different individuals for what they should do right now?
Somebody who wants it now, you need to talk to us and whoever else you're comparing us against. Hopefully it's just us, but if you want to talk to your business broker, that's fine too. Talk to us immediately. We're going to get you a valuation. We need to go quickly because the last thing we want is to see declining revenue. That's just bad. If you're younger, so if you're in the bucket 2, talk to us now. I know this, now.
Doesn't matter. Talk to us.
Well, and this is why. I heard somebody say this. They held their business for 10 years. In years 6 through 10, they added no value to the valuation that he could see, no material value to the valuation, but kept the stress, the headache, all the things, and then he sold, and he was like, I would have made just as much money. I would have had that investing in the market, investing in my larger fund, and I wouldn't have had all the stress and headache. So if you're going to hold, which is great strategy, talk to somebody today who I felt like he could go now or he could go later. Him and his wife could go now or later. They're middle age. If you're not going to go now, know why and what you're shooting towards, because you're going to have to exit the business. If it's to a kid or to employees or somewhere, just know what it's worth so that you can build to the next level, and don't throw good money after bad. If you're going to go buy a bunch of equipment, is that going to change your valuation materially? Are you about to just saddle yourself with debt and have to take on more risk? That's why I would say, in both cases, talk to us now so we can give you a fair valuation, because you just need an outsider to say, hey, this is what it's worth, and here's where we think you could be in 5 years.
That's a good point. I think most people overvalue their company. They think it's worth a lot more than it really is. They don't see all the warts, basically. They just see the great parts. So there you have it, straight from the Haas's mouth. Really bad pun.
No, that was good. That was good. Yeah.
I was just looking at the logo on your shirt there.
Yeah. And I would end with this. I really appreciate it. If someone's interested, you can reach out to me, david.mitchell@hoshtreeadvisors.com. We're also, we're happy to give away. We have an investor insight guide where it basically walks through in a one-pager what investors are looking for and what they're not. So we give that away for free. It's our way of just saying, hey, kind of know what we're doing. Here's what it is, but that allows you to say, hey, what am I building towards, even if we don't have a conversation. So you can reach out, and I'm happy to send that without us having a conversation. But I'd love to do valuations for anybody who is thinking about exiting in the next 20 years.
And yeah, so you know what you've got and what the opportunities or options are
Absolutely.
down the road. So
Yeah. Well, thank you so much. Yeah,
so
absolutely.
much. It's been a real pleasure learning more about all of this from you.
Absolutely.
And if you are watching this or listening to this later, come check out the show notes down below. Give us a thumbs up, subscribe, and get in touch with David if you are thinking at all about exiting your tree care company.